Hello everyone and welcome. My name is Tim, trader at the CAM Compound, and it's time for our stocks analysis. Let's get right to it. In front of us is the S&P 500, and you can see that we've had a decent run today, or still having. The market will close in 5 minutes, and the same goes for the Nasdaq, which seems to be making its W pattern like we were talking about. We will see though, because this is for a couple of reasons, mainly being macroeconomic, meaning the broader economy over the world, although it's mainly focused in the US. This is because all of the banking crises that we've seen, or not necessarily crises, but the banks that are in trouble, are generally a sign of the financial markets having deeper trouble. This is called a liquidity issue in this case, meaning that there are not enough dollars going around. This is by design, as the Federal Reserve has been doing quantitative tightening, meaning that they've tried to pull back the amount of dollars that are circulating to kind of keep inflation down. If we go very short, that is like the in a nutshell explanation. There's many cogs and levers and parts to it, but that is kind of the essence of it. Now, the Federal Reserve has been doing this by raising the rates, for instance, the interest rates. With these banks showing so much trouble, the market is basically saying, hey, Jerome, you are saying that you want to take the interest rates much, much higher, but we think that you can't and that you're stuck and will, oh, my apologies, and will soon have to make a pivot, as it's called. We also see this in the 2-year Treasury, which we can show on a CNBC. There we go. Oh, that works. And what we see here, basically, this is kind of a proxy for the interest rate. As you can see, especially if you take like the entire chart, you see that this is pretty close to the interest rate. Now, if we look a little bit closer, then since all these issues started with the banks, you can see that they crashed pretty quickly. This is one of the biggest markets. The credit markets are, I think, about 4 or 5 times as big as the entirety of the stock market. All of it. 5 times bigger. This is a big market. Moving from 5% to 4% in, let's say, a week is a very big move. That is a 20% difference. And there's a lot of money going on in that. So this is definitely the market saying, Jerome Powell, we think that you're bluffing. So we'll see. That is also why the stock markets are rallying, because they think Jerome Powell is bluffing, and that means lower rates, and that means higher stocks and crypto, probably. What the stock market doesn't seem to be reminding itself of is that a financial crisis will also mean much, much worse conditions for assets. But that is, something for probably in a couple of months. That is what's currently happening in a nutshell. If we then look at price action, we see that the S&P 500 has kind of like gotten this area here back and is now looking to close above. Then we want to see confirmation for it to kind of go back to this area right here between the 400 and the 407 approximately, maybe 410. That is kind of the next major resistance zone, and from there on out we do have a higher low and a higher low and a higher low. From there on out we can try to make a new higher high. That is kind of what we're going for, and that is the same thing here in the Nasdaq, although we did see just a lower low. But now we will be trying for a new higher high from around this area. That is kind of the main thing that we're looking at. This area could be a potential short for tech stocks, but for now they seem to be fairly decent. So let's have a look. We will need some proper we could still see a proper divergence, and we need some proper confluence before we do anything. So that is what we've currently got. Now let's look at a couple of stocks and some of our positions. Like gold, obviously, when there's a crisis in the financial markets, gold is a surefire go-to. Same thing as silver. They are generally considered to be safe havens in that case, to a certain extent anyway. This can go, I guess. This is a gold miner, bare gold, not actual gold, because that is currently at 1800 or 1900, I believe. But we do see here that that this gold miner, one of the best ones, is doing quite well. We also see that AMGN is kind of slowly picking back up the pace, and we could see a move back towards this kind of resistance here. Next thing we see is General Electric. It's fluctuating a little bit, but we do see this downward trend approximately like this and this. It's in a bit of a channel, but it's at a spike, so it's kind of hard to tell for now, but the trend is still downwards. We also added to Alibaba, which brings our average to 85.33. In a long, China is also having some issues, but of course Alibaba is one of the major suppliers of China, and from China to the rest of the world. I believe they were also expanding to India, but I might be making that up. I believe I've read that, but don't quote me on it. And that could definitely move up to, let's say, about 94, maybe even a little bit further. There are some interesting gaps. There is still a gap here that needs to be filled at 118. So fingers crossed, and for now it does seem to be slowing down its descent a little bit. It's not quiet. It made a little bit of a divergence, but of course that's not enough. That was it for today. I think that's enough of an info dump. I will see you all in the next one, and don't forget, no matter what happens, no matter which bank falls, keep calm, keep cool, and keep compounding. Thank you so much. Bye bye.